The broadcast is now starting. All attendees are in listen-only mode.
Hello, good afternoon, and a very warm welcome to you all. Welcome back. Delighted you could all join us for this latest PKL Tax webinar. I'm delighted and, I have to admit, somewhat relieved that my learned colleague, David Wiscombe, is back with us today. Good afternoon, David.
Well, good afternoon, and greetings from sunny Finchley, and a lovely day out there. And Shana Tova to you all.
Lovely view as well over Tesco's here in sunny Finchley, so maybe we'll post a picture of that for next time. But where were we last time, before we all disappear to sunnier climes, no doubt? We were talking about partnerships and taxation. We got a little bit carried away with ourselves and didn't have time to finish. So today is very much the sequel to our previous webinar, and while we're at it, we should mention all of our previous webinars. They're actually on YouTube if you ever fancy, if you can't sleep at night or you just want to revisit those halcyon days of previous topics. Have a look on YouTube, and they're also available via our website. So if you did miss the previous one, you will find it there. So today we're going to talk about capital gains tax and partnerships.
Yes, and much of the content of this is based on an excellent tome that's published by a company called Bloomsbury Professional.
Written by?
Well, modesty forbids, but it seems to be me.
Yes, oh, okay.
And happily we've blagged our way into persuading Bloomsbury to give a discount of no less than 20%.
20%?
20% to listeners to this webinar. And I think the magic code to use is PT20. Now that discount's available for the next 2 months. Sadly, I'm not on commission here, but hopefully it will be of use to our listeners.
Okay, so there you go, 20% off your book. This is all going splendidly. So we're going to follow on from what we talked about last time. Let's dive in, but before we do, we should, as always, say that we do very much welcome questions, well, those that we can understand at least, don't we? So please feel free to type your questions. If time permitting, we do try and answer them all. If not, provided I don't accidentally delete them, we will try and come back to you afterwards. But please do, if you've any questions or thoughts, we will try and answer them live on air. So type away via the app on your computer. So without further ado, David, let's just, as it were, set the groundwork for CGT and partnerships. The starting point, no surprise, is they're transparent for tax purposes, aren't they? Well, as a general rule.
Yes, as a general rule, they're transparent. But therefore, the important point to understand is that partnerships do not pay capital gains tax. Partners pay capital gains tax, partnerships don't. Mm-hmm. So there is the concept of a partnership capital gain is really a little bit misleading, because in capital gains tax terms, you're always looking at allocating costs to partners, allocating proceeds to partners, and each partner having its own, having his or her own gain.
Right, but a couple of, I think, important caveats to that. First of all, when we talk about partners, or partnerships, I should be more precise, for these purposes, we're also talking about LLPs.
We're talking about partnerships and LLPs. Partnerships are always transparent. LLPs are almost always transparent. Section 59A talks about the circumstances in which LLPs cease to be transparent. They cease to be transparent if they permanently cease business, unless they are then liquidated without undue delay. And they also cease to be transparent if at the point at which a liquidator is appointed.
Correct. I think one point we've been looking at recently is LLPs and administration. That can cause a little bit of difficulty. I don't think the legislation, excuse me, is entirely clear. I think the general view is a partnership administration does remain transparent for tax purposes as a general rule.
An administrator being distinguishable from a liquidator for that purpose. And Section 59A talks about a liquidator, not an administrator.
Mm-hmm. So there you go. So as a general rule, though, as we said, subject to those points, LLPs generally transparent, and as you said, it's the partners who pay the CGT, not the partnership.
What have we got now? Statement of Practice D12. Now, Statement of Practice D12 is the rule book, really, as regard capital gains tax and partnerships. The problem with the legislation is that it doesn't really address very well the concepts of a partnership not being subject to capital gains tax, but individuals being subject to it, and the gaps in the legislation are filled in by the statement of practice. It has no statutory authority, but everybody follows it.
Yeah, it's a little bit unsatisfactory, really, isn't it? I mean, we're up to page 17,319, this statement of practice on in the Red Books, and yet, as you say, this is not legislation. It's filling in gaps in the other 17,000 pages. It's also interesting the notes to the statement of practice that talks about statement of practice detail provides a reasonable result in most circumstances, which doesn't overly inspire confidence. But as you say, these 2-3 pages are pretty much all we have to go on for these purposes, isn't it?
Yeah. I mean, you can assume that the revenue will follow SPD 12, and really it's signposts that allow you to make progress through what is otherwise perhaps a bit of a barren wasteland.
Okay.
Basis of valuation. When we're looking at partners and the share that partners have in partnership assets, there comes a question of how you value those assets. So if a partnership, for example, has a 100% holding in a limited company, and you've got 10 partners, each with a 10% interest, the question is then for capital gains tax purposes, do you value that? Do you regard that partner as having an asset that is worth a 10% holding, or do you regard that asset as regard the partner as having an asset that is worth 10% of the value of a 100% holding?
Mm-hmm.
Because the two numbers will very often be different. And the answer is that the valuation is not discounted for minority.
Yeah.
So the valuation is a valuation of 10% of a 100% holding.
Correct. And I think, to be fair, the statement of practice make that clear, albeit strictly on a non-statutory basis. But yes, that's the paragraph 1 of statement of practice D12 covers that point.
And when it comes to allocating how partners deal with partnership gains, what you don't do is compute a partnership gain and then allocate that gain between the partners in a particular way. What you do is allocate every time that there are costs of an asset, they get allocated between partners. Every time there are proceeds of an asset, they get allocated between partners. Now, if the profit shares of the partners have remained the same, if you've had the same partners throughout and they've shared the profits and losses in the same way throughout, then you get the same practical effect whether you allocate a gain of the partnership or whether you allocate costs and proceeds. Where it gets complicated is where there have been partners coming in or out of the partnership, or where profit sharing ratios have changed during the lifetime of the partnership. That's when it becomes really crucial to recognise that what you're allocating are proceeds and costs, not gains and losses between partners.
Okay, and we're going to have a look at a few examples that explore that in a little bit more detail.
And particularly, that can impact upon the way in which entrepreneurs relief, holdover relief, rollover reliefs operate. And we'll have a look at that in a bit more detail.
All right, so that sets the scene. Let's just flag up the areas we're going to look at in the next 40 or so minutes, David.
Can we look at what I was talking about, changes in asset surplus ratios, changes in the way in which costs and proceeds are allocated between partners. We're going to look at entrepreneurs relief. We're going to look at the 7 circumstances in which entrepreneurs relief can be relevant to partnerships. Gosh, didn't realise there were that many. Yes, there are. We're looking at how rollover relief works for partnerships, holdover relief, and then incorporation relief, including I think there's been a fairly recent change of revenue practice that we need to mention.
Okay, so let's start then with changes in asset surplus ratios.
Now, what we mean by this is how, under the partnership agreement, the partners have agreed to share surpluses on disposal of assets. And it may be that all of the profits and gains are shared in a particular way, or it may be that gains on assets are shared differently from profits. It may be that gains on particular assets are shared in a particular way. But in respect of each asset, there will be an asset surplus ratio for that asset.
And that will usually be governed by the partnership deed.
Yeah.
I think the revenue say if it's not covered, then you look at how the actual profits are allocated between the partners, etc., etc. Again, the statements of practice does provide a reasonable amount of guidance to assist you in more complex cases.
Yeah, and I emphasise it's really only in complex cases that this becomes difficult. But it does mean, but we'll be talking through some reasonably straightforward cases here, just to understand the principles that we need to apply. So every time that there's a change in the asset surplus ratios, there's a deemed disposal by the partner who reduces his share, and there's a deemed acquisition by the partner increasing the share.
Right.
Normally, that deemed acquisition and disposal is at balance sheet value. So at whatever value the asset sits in the balance sheet, then that's the consideration that's deemed to pass on the change on the share of the asset. In special cases, market value is substituted. It's firstly, there may be a payment off balance sheet at the time at which there's a change in asset surplus ratios. If so, that payment off balance sheet needs to be taken into account in addition to the deemed consideration.
So one partner pays another for the right to join the partnership or for a greater share of a particular asset, for example.
Exactly.
And that's para 7, payments outside the accounts and the statements of practice.
And you also need to look at the position where the partners are connected. Now, partners, of course, are connected persons for CGT purposes, merely by virtue of the fact that they're partners. Partners are connected persons, and normally, therefore, you'd expect market value to be substituted because the transaction is between connected persons. However, the revenues practice is not to substitute market value in relation to these transactions unless the partners are connected otherwise than by being in partnership. So if they're a father and son in partnership, for example, or an individual and a company which he controls in partnership together, then market value could be substituted. But even then, market value is substituted only if the revenue are of the view that market value would apply if the parties weren't otherwise connected. So if you've got half a dozen partners, of whom 2 are, should we say, father and son, and it is the practice of all of the partners on any transaction not to apply market value indiscriminately, whether it's a transaction between connected persons or not unconnected persons, then in that circumstance the revenue wouldn't substitute market value, because clearly market value would not be applied even between unconnected parties.
So genuine commercial arrangements should be left alone.
They should indeed.
Okay.
We next have an example.
Okay.
Which makes things crystal clear, hopefully. A and B are equal partners. And in the balance sheet, there is a partnership asset which costs £200,000. It has a market value of £300,000. Now, clearly, A and B each have a base cost of £100,000 because that was they had equal profit sharing ratios when the expenditure was incurred. They now introduce C as a 20% partner, and there is no off-balance sheet payment made. So that's the scenario we have.
Okay, so fairly straightforward. We're just bringing in a new partner, and we've got, let's call it a building, for example, on the balance sheet. As you say, it's appreciated in value.
Now, assuming we don't revalue the thing before C joins us as a partner, we've got A and B each owning 50% with a cost of 100,000. As a result of the change in the asset sharing ratios, A and B are each going down to 40%. They're each therefore disposing of 10%. That 10% is applied on an arithmetic proportional basis. So they're disposing of 10%, which cost £20,000 for the balance sheet value, which is £20,000. We don't apply the normal part disposal rules here. We just look at the percentage arithmetically that's being disposed of. C is treated for capital gains tax purposes as acquiring 20% for 20% of the balance sheet value, £40,000. So we've got the costs to carry forward for the subsequent disposal of now 80, 80 and 40. That's reasonably straightforward.
All right, so let's be clear here. Notwithstanding the change in partnership sharing ratios, we're not saying we're crystallising any tax at this point. This is just a bit of mathematics to keep track of what the revised base cost for each partner is.
Absolutely. There is no gain at this point because there has been no revaluation. We've got a disposal at the balance sheet value, but the cost is the balance sheet value. It would be different if we amortised the cost or if we revalued upwards, but we're keeping it simple.
And in simple terms, we can still see the base cost is still 200, It's just been split now 3 ways instead of 2 ways.
And you might think, well, it's a bit odd that this guy C who's come in and hasn't paid anything has nonetheless picked up a base cost, but we'll see why that has to be in the next slide, hopefully. So, subsequently, this asset is sold for £300,000, its market value, and that accounting gain of 100,000, it will be credited in those proportions, 40, 40, 20. So in accounting terms, A and B and C are each gaining that accounting gain in those proportions. Now, for capital gains tax purposes, look at the computation now for A and B. They each have proceeds of 40% of the 300,000, which is 120. They have a cost to carry it brought forward of 80, so they each have a gain of 40. C has a gain of 20 because he has proceeds of 60 and he has a base cost of 40 to set against it. So in this situation where there's been no revaluation, no prior revaluation, the capital gains tax works because we're charging capital gains tax on the same figure as is the accounting gain that gets credited.
Yeah, so we've got an accounting gain of 100 and gains for capital gains tax purposes of 100 as well. I mean, no surprises there.
And importantly, they are credited in the right proportions. C has in fact got a gain of 20. He's paying tax on 20. That makes sense of why he has to have a base cost of 40 in the first place.
Okay. So yeah, there's no mischief here, is there?
No,
really,
you just need to keep a slightly clear head.
Okay. Now, so far so good. That's, I think, all fairly intuitive and straightforward. It gets us to where logically we should be. We need to compare and contrast that to this next example, where, in our example, this property has been revalued up to its market value, £300,000, before the introduction of the new partner.
Yeah.
Okay.
So, on revaluation, before introducing C, that revaluation gain is £100,000. And since A and B are equal partners, they each get credited with half of £100,000, which is £50,000. So they are credited with £50,000. There is at that point no tax charge. Revaluation of the asset is not disposal. So although they've been credited, all they're doing is changing the value at which they choose to carry the asset in the balance sheet. That is not a disposal. On a change of profit sharing ratios, however, we said on change of profit sharing ratios, there's a deemed disposal of the asset at the balance sheet value. So when A and B introduce C as a partner, they're each treated as disposing of 10% of the asset. 10% of the asset still has a CGT cost of 20, but the disposal consideration is now 10% of 300,000. So we've got a disposal consideration of 30. So there is at that point capital gains tax on 10,000.
So we have, it's the revaluation combined with the change in profit sharing ratios that triggers an upfront tax charge. That perhaps this is when we start getting into slightly unexpected tax territory, because again, there's been no actual disposal.
There's been no actual disposal, but SPD21 deems there to have been a disposal. And as we'll see, hopefully, it has to work this way to make sense.
Yeah,
as we'll see. So C is treated for capital gains tax purposes now as acquiring 20% of the asset for 20% of its market value, or sorry, 20% of its balance sheet value of 60,000. So the costs carried forward for a subsequent disposal. Remember, the CGT costs are these figures. So A now has £80,000 of costs to carry forward. B has 80,000 and C has a base cost of 60,000.
Okay, so those are our base costs. And now we're going to look at the position when we actually dispose of this at the same 300,000. So assuming it's just been revalued, bring in the partner, and then pretty much an immediate sale.
Yeah. Okay. So because we've revalued, there's an accounting gain of nil on the sale. We've already taken effectively the gain, but on crediting to A and B's accounts, capital accounts. So the accounting gain of nil. For capital gains tax, A and B will each have a gain of £40,000.
Yeah.
Because they will have proceeds of 40% of 300, which is 120, minus their cost of 80. So they each have a gain of £40,000. Yeah. C has no gain. He has proceeds of 60,000 because he's entitled to 20% of the profits at that point. But he has a cost of 60 to set against it. So that again gives the right answer, because if you look at who has actually benefited from this transaction, it is only A and B that have had any benefit. C has had no benefit. He's not, the asset's been sold for 300,000, but he has, there's been nothing credited to his capital account because there was no gain to credit. Yeah. A and B have effectively had £50,000 between them, and they're paying tax on that £50,000 as to £10,000 at the time of the change in the profit sharing ratios, and as to £40,000 on the eventual disposal of the asset.
So if we do the maths, A and B paid had a gain of £10,000 on the revaluation originally. On the revaluation and the change in profit sharing ratios.
Yes.
And now on the sale, they've both got gains of 40k.
Yes.
So we've still got the gain, the full 100k, being taxed,
yes,
as in our previous example.
And it's taxed on the right people.
Correct.
Who have actually benefited from the gain.
It took me a long time to get my head around this, but there is clear logic there,
isn't it? There's absolute clear logic in it, but only if you recognise the principle that you don't compute a partnership gain and try and allocate it between the partners. You compute the costs and the proceeds and allocate them between partners, and then you get the right answer.
Yeah.
If you try and compute a partnership gain, you get into all sorts of difficulty.
Agreed. And none of this you will find in the legislation. There's not even a clue, is there?
No. So SPD 12 is the
para 4 specifically deals with this scenario. So hopefully I hope that's illustrated the point and will help people get their heads around exactly what that para 4 is saying, because on a cold read it's far from obvious. So that's CGT on disposal of assets where there's been a change in profit sharing ratios.
The same principle applies on mergers, because on a merger everybody's disposing of a bit of everything.
Yeah.
So this is you can run through the detail of this at home, as it were. But A, B, and C own A, B, C, and Co in equal shares. D, E own D and Co in equal shares. On merger, each own 20% of the merged firm.
Okay.
Because they've got 5 people. So using the same principles that we've just seen in the earlier simple case of one partner joining, you can make up for yourself. You can work out what the answer will be. A, B, and C have each given up 13.3% of each A, B, C, and Co asset. They've acquired 20% of each D and Co asset. D and E have each given up 30% of each D and Co asset and acquired 20% of each A, B, C, and Co asset. There's no problem at all if there's been no revaluation, because although they've made disposals, there's no gain arising for anybody. If anybody has made revaluations, or if the assets have been amortized below cost in the balance sheet, because if they've been amortized below cost and they're therefore being transferred at a figure that's less than original cost,
right,
then equally there could be a loss on the change of the profit sharing ratios. But if they have been revalued, there may be gains on one or other of those assets. But of course, you've then got the possibility of rollover relief, because not only is each partner giving up a disposal of an asset, he's also making an acquisition of an asset. So their rollover relief would need to be brought in.
Yeah.
And if there isn't a rollover, and if there is a gain, which would only arise if there's been a revaluation, then it's a disposal of part of a business, and potentially entrepreneurs relief will come in.
Okay.
So all of this is...
Which we'll come on to. And again, I think the assumption in all of this is in any merger such as this, it's very much the case that this would be assumed to be happening as part of normal, genuine commercial arrangements on an arm's length basis. So there should really be, unless this is all one big happy family, as it were, very little risk of HMRC seeking to impute anything other or calculate the gains on anything other than the valuation in which we've talked about.
I must say my experience of HMRC is that there are few inspectors actually understand how SPD 12 operates in these circumstances, let alone seek to substitute market value. But
yes, they did clarify recently, didn't they, where a partner transfers an asset into the partnership and how that should be treated. And I think they acknowledged that historically they hadn't dealt with that correctly. Yeah. So don't assume HMRC know what they're dealing with here.
But now our listeners do.
Indeed, they do.
Right.
Okay.
So let's talk about what are we going to talk about next?
We're going to talk about
entrepreneurs relief.
We are indeed.
Right. Here we do get a certain amount of guidance on entrepreneurs relief.
Might say a little bit too much these days. It's been legislation that's been very much expanded upon in recent years and is quite difficult to follow. So we're going to start looking at section 169I that deals with material disposal of business assets, I think.
And specifically, we're looking at the definition section of 169I. It was back at 169I8, which gives you a little bit of guidance on how you deal with partnerships and entrepreneurs relief. Because entrepreneurs relief, of course, depends upon, ignoring companies for a minute, depends upon a business being owned by someone.
Correct.
And so section 169I8 makes it clear that a partnership business is treated as owned by each individual member.
So it's sort of building on this idea of transparency again, isn't it? But making it beyond doubt for these purposes.
It tells you what you would expect the answer to be.
Mm-hmm.
I mean, it gives you the expected answer. A disposal of an interest in the assets of a partnership, i.e. by a partner perhaps leaving a partnership, is treated as a disposal of a part of a business for entrepreneurs relief purposes, and therefore potentially unlocks entrepreneurs relief on a partner retiring from a business. When a sole trader takes on a partner, as we've just seen, there is then a change in the profit sharing ratios.
Yeah, the
goes from
principle's the
100%,
same, yeah.
100% to something less than 100%. That's just treated as a disposal of part of a business. And the conditions for entrepreneurs relief are applied separately to each partner. So you can perfectly envisage situations in which on a single disposal of a business, some partners might qualify for relief and others might not. For example, if you had a number of partners in a business, some of whom had been partners in the business for more than a year,
right,
one of whom hadn't, and the business was then sold, then that partner who had only been a partner for less than a year wouldn't qualify for entrepreneurs relief, even though every other partner would, because the conditions are applied separately to each partner.
Okay, so that's the sort of general framework, and as I say, we'd refer you to 169I8 that sets out exactly how we should interpret the entrepreneurs relief rules in the context of partnerships and for partners. So I think we flagged up before 7 different cases when it comes to looking at entrepreneurs relief, David. We're not going to look at all of these in detail, but do you want to give us the highlights, as it were?
Well, first we need to just recognise that there are these almost 7 different reliefs. Not quite, but almost. So when can entrepreneurs relief be relevant to a partnership? 1, on the partnership as a whole disposing of the business.
Right.
2, on a partner disposing of an interest in a business. That might be on retirement, or it might be simply on a change in the profit sharing ratios. And of course, retirement is only an extreme version of a change in profit sharing ratios. It's a change from whatever it was to 0. So a partner disposing of an interest. On introducing a partner for the first time, when a sole trader introduces a partner, again, it's a change in the profit sharing ratios, but it's entrepreneurs relief may be relevant. May be relevant on a disposal of assets following cessation of the partnership business, of assets that are used on cessation. So the partnership business ceases. There are assets that are in use for the purposes of the partnership business. At the time the partnership business ceases, then relief can be due on those assets. And we're talking then about main relief, not associated disposal relief, but the principal relief.
And then these next 2, these are sort of almost very much freestanding, aren't they? I think they have their own particular rules.
They do indeed, yes. Trustees can claim entrepreneurs relief in respect of what the legislation calls a trust business disposal. And the rules for that are a little bit counterintuitive. You would think, for example, that trustees who are themselves partners in a business might be able to claim entrepreneurs relief on a disposal of their interest in a partnership. That would make sense, wouldn't it?
It would.
Yes, but of course they can't, because that is not a trust business disposal. It might be a disposal of a business made by a trust, but it doesn't meet the definition of a trust business disposal. So we'll look at that a bit later on.
Okay.
Partners making what's called an associated disposal. We'll look at that in a bit more detail. and that is an asset that's owned by a partner but used for the purposes of a partnership business. And there's also the possibility of where you might have a corporate member of a partnership, then entrepreneur's relief could be relevant on a disposal, not a disposal made by the corporate member, of course, because entrepreneur's relief isn't available to companies, but it may be available to shareholders of the company on the disposal or liquidation of the company, which is a corporate member of a partnership, because a corporate member of a partnership will itself, generally speaking, be a trading company, and therefore entrepreneur's relief in principle should be available.
Yeah, and they had a couple of attempts, the revenue, didn't they, to get the rules as they would like them there.
Yeah. It's we're not going to be looking at that in too much detail, but
the broad thrust of it is that the individual shareholder should have a indirect 5% interest in the assets of the partnership. Is where we've now ended up, isn't it, David?
Yeah.
Okay, so those are our 7 cases. Let's have a look now at disposals following a cessation of the partnership business.
So I mean, on the the first one that we talked about a partnership disposing of the business is relatively straightforward. It's a partnership disposing of the business. The partnership's transparent. You allocate the gain and the proceeds and the costs to the partners. Who qualify, don't. On this disposal following cessation of the partnership, this is under section 169I4. Relief is available in respect of an asset that is in use for the business at the time of cessation. And the business has been owned by an individual throughout 1 year ending with the cessation. And this is where the condition might be fulfilled by some partners but not others, because some partners may have owned the business throughout 1 year and others not. And then there's the question about whether it's a cessation within 3 years of the disposal, where the business ceases and then the disposal takes place within the following 3 years.
Yeah.
It is recognised, I think, now that relief, that form of the entrepreneur's relief, is available regardless of whether assets are owned by a partnership or whether they're owned personally by the partner, because section 169I4 doesn't say anything about assets having to be used, so having to be owned by the partnership. The condition is only that the asset is in use for the purposes of the business. And it doesn't matter whether it's owned by the partnership or individually by the partner. So this is the main relief, and don't confuse it with associated disposal relief, which we'll talk about a little bit later on, which of course only applies to assets that are owned by the partner, not the partnership. Now, the interesting point, the mildly interesting point, in relation to this use of the relief on the disposal following cessation of the partnership business, is what does the legislation actually mean by cessation of the partnership business? Does it mean that the partnership business must completely come to an end?
Right.
As in, shut up shop, convert the shop into residential accommodation, close business, retire, absolutely, the business comes to an end.
Yeah.
That clearly is a cessation of the partnership business.
Yeah, unquestionably.
But what happens if the partnership business is sold to somebody else as a going concern? Perhaps the partnership business is sold, but the buyer might not want to buy all of the assets that have been in use for the partnership business. Now, clearly, any gain made on the disposal of the business will qualify for entrepreneur's relief under the main rules, under the basic rules. Question is, will you then get entrepreneur's relief in respect to a separate disposal of assets that the purchaser didn't buy? Has the partnership business ceased in those circumstances? Well, It's ceased to be carried on by the partnership, but the business hasn't in fact ceased to be carried on at all because it's been carried on by a purchaser.
So what's the answer, David?
I have not the remotest idea. Well,
is it not in that book?
Well, yes and no. The conclusion I come to is that there is a perfectly reasonable argument that says that the relief is due when the partnership ceases to carry on the business, even though the business continues to be carried on by another person. In other words, I think there's a perfectly reasonable argument that says that cessation means ceases to be carried on by a particular person rather than ceases to be carried on altogether. But I don't think that it's beyond all doubt at all. And until the case comes before the courts, I think there must be some room for doubt about whether you get the relief on mere sale of a business rather than simply shutting up shop. Whichever way you interpret it, there are anomalies, and I identify some of those in the book.
But there's certainly a filing position here, isn't there?
I would say there's certainly a filing position, and the revenue guidance doesn't cover it. So that's partners and entrepreneurs relief on the cessation of a partnership business. What are we going to talk about next?
We are going to talk about trustees, David, and this sort of almost free-hanging relief that, as you say, doesn't really mesh very well with the rest of the ER rules.
As I say, it's best, I always think, to think of ER as being essentially three reliefs. It's the main relief, there's trustee business disposal relief, and there's associated disposal relief. And they might as well be called by separate names, and sometimes it would be easier if they were called by separate names. So trustees get this relief on what the legislation calls a trust business disposal. In order to get the relief, and the detailed terms are in section 169J, firstly there has to be a qualifying beneficiary.
Right.
A qualifying beneficiary is, broadly speaking, somebody with a life interest.
Okay.
And of course, the thing gets a bit complicated if you've got more than one beneficiary with a life interest, or if you've got a life interest in some of the assets and not the others of the assets. So the whole thing can get a bit interesting. But let's keep it simple. A qualifying let's assume you have a trust where a single fund and a single beneficiary has a life interest in the whole of that fund. Qualifying beneficiary life interest. Trustees, we're looking at an asset that is used for the purpose of a business that is carried on by the qualifying beneficiary, either as a sole trader or in partnership.
Right.
Throughout a period of 1 year, ending no more than 3 years before disposal. So it's sort of
we've heard that
linked
before,
in with the main rules. It sounds broadly familiar. And the third condition is that the qualifying beneficiary ceases to carry on business at the time of disposal or within the previous 3 years. So this sort of ties in with the disposal of assets following cessation of business that we were talking about a minute or two ago. But you'll see this is predicated on the assets being owned by the trustees, but being used for the purposes of a business which is carried on by a beneficiary. Right. It is not about assets being used for a business carried on by the trustees in partnership. It's irrelevant whether the trustees are partners or not. They're not debarred from relief. It's possible that there could be a qualifying beneficiary who's a partner in the business, and the trustees themselves would also be partners in the business. And that wouldn't debar the trustees from relief, but it would simply make no difference. The relief would depend upon the qualifying beneficiary carrying on the business.
It's not something we see very often, is it? To be fair, it's a fairly narrow set of circumstances where you're ever going to see this relief.
Well, yes, but when you do see it, it can be extremely valuable and extremely embarrassing to trip over it by not recognising it, because that third point about the qualifying beneficiary ceasing to carry on the business on disposal is crucial. Imagine you've got, as is not uncommon, you've got perhaps trustees that own farmland,
right,
and you might have a qualifying beneficiary who has an interest in possession in that farmland, and the qualifying beneficiary might be a partner in the business in the partnership that farms the land. Now, what happens if a bit of that farmland gets consent for residential development, and you sell it on? As you might think, well, that looks like the sort of thing that you might get entrepreneurs relief on. Bit peculiar that if this were a sole trader owning farmland and he sold off a bit of land for development, then typically he wouldn't get entrepreneurs relief because it typically wouldn't be disposed of the whole or part of a business.
Yes, I was going to say that's the key point here, isn't it? Is it an asset you're selling? Is it part of a business? So that's arguably another conversation.
It is another conversation, but of course, for trust business disposals, it isn't a requirement that you sell part of the business. It's a disposal you're selling an asset used for the business. So in that circumstance, although you wouldn't perhaps expect there to be entrepreneurs relief, because you're not selling part of a business, nonetheless, you've got this potential relief on a disposal by trustees. And in the situation that we envisaged of the land being owned by trustees, farmed by a partnership involving one of the qualifying beneficiaries, trustees sell off a bit of the land. There's no reason to imagine that at that point, I mean, why would the qualifying beneficiary cease to be a partner in the business that continues to farm the rest of the land? I mean, it's not a natural thing for him to do. But if the partnership continues to farm the rest of the land and that qualifying beneficiary continues to be a partner in that partnership, then the trustees don't get trust business disposal relief, because that third condition, that the qualifying beneficiary ceases to carry on the business on disposal or within the previous 3 years, isn't met. And it's a strange and arbitrary condition. So in that situation, the qualifying beneficiary would need to make sure that he did in fact cease to carry on the business for no very good or obvious commercial reason, simply in order that the trustees could get their trust disposal relief.
Yeah. So all a little bit odd, really.
It is all a little bit odd.
I think the other point we should mention is there's a £10 million lifetime allowance for entrepreneurs relief, isn't there?
There is.
That's shared in these circumstances, isn't it?
Yes. So if the qualifying beneficiary, so a claim made by trustees in this circumstance, needs to have the consent of the qualifying beneficiary, because effectively the qualifying beneficiary is giving the benefit of part of his lifetime limit to the trustees.
So yeah, all a little weird and wonderful, and that moves us on to associated disposals. Yes.
Now these rules were changed a couple of years ago.
Yeah.
I forget when. So in order for there to be an associated disposal, there needs to be a material disposal. That is a disposal dealt with under section 169. H, is it? The main disposal. What I've talked about is the main disposal. There has to be a material disposal on which the associated disposal can piggyback, or with which it could be associated. And associated disposal relief in the context of partnerships has to meet particular conditions. If the material disposal is a complete exit from the partnership, i.e. the partner is leaving the partnership altogether, then the material disposal must be a disposal of at least a 5% interest. The material disposal must be of at least a 5% interest, or it must have been at least 5% for at least 3 years in the previous 8. This is to deal with the circumstance of somebody who retires from a partnership in a phased way. So he might have been a 10% partner, then cut down to 4% interest before finally leaving. So that's because he would then have had 5% for at least 3 years in the previous 8. Then he would meet his test. So alternatively, if the material disposal is not a complete exit, then it's reasonably straightforward. It's got to be a 5% interest.
And it's worth comparing. I think the rule used to be as long as you dispose of any fractional part of your interest in the partnership, that could be enough to trigger or allow you to get entrepreneurs relief on the associated disposal. And indeed, it was suggested even a transfer of an interest between husband and wife, where there's no real economic disposal in most circumstances, could have got you into these rules. So this is why they've been tightened up.
Yeah. It's worth actually mentioning, although this 5% test now applies to associated disposals, it's just worth reminding people that there is no minimum interest test for main disposal, material disposal relief for partnerships. So if you're disposing of shares in a limited company, if you want to get entrepreneurs relief on disposal of shares in a limited company, then there are rules as to having a minimum interest in the company. There is no similar rule for partnerships. So if I've got a 0.001% interest in a partnership, and the partnership business is sold, then in principle I can look at entitlement to entrepreneurs relief. because I'm in it because I own the business. Doesn't matter how big the slice of the business is. There is no minimum test for a material disposal of a partnership interest.
Unlike now for associated disposals.
But you can only piggyback an associated disposal onto a material disposal if the material disposal itself is big enough.
Yep.
So you could readily envisage circumstances in which there could be a material disposal that qualified for entrepreneurs relief. There could be a disposal of an asset made at the same time, but because the material disposal was qualified for entrepreneurs relief, but wasn't big enough to piggyback the associated disposal on it, you don't get the associated disposal relief. If you see what I mean.
Simples. Yeah.
Simples.
No.
Simples.
Yeah.
Usually associated disposal restrictions apply. And that you don't get the full relief if the asset wasn't used by the business throughout the period of ownership. If it was only partly used for the business, or the owner was involved in the business for only part of the period, or if rent or other consideration was given for the use of the asset any time after 5th of April 2008.
Yes, albeit those restrictions aren't particularly well defined by the legislation, are they? So exactly how they apply is not beyond doubt, except in perhaps the most straightforward of cases. So there may be a little bit of wiggle room, as it were, albeit I think the manuals do provide a little bit of additional guidance there.
And it's also worth remembering that we're going back to the disposal of assets on following cessation of business. That's why it's crucial to recognise that what we're claiming there is not associated disposal relief. It is main disposal relief.
Right.
And these rules don't apply the restriction to main disposal relief. So it's hugely significant that you know which relief you're claiming.
Agreed.
I think exhausts our. I'm not sure what exhausts our knowledge or our interest in entrepreneurs relief. I was hesitating there for a moment.
All right. Well, let's move on.
Let's move on to rollover relief.
Unless anyone's got any questions, but no, maybe not. Let's roll on. So, okay. Let's talk about rollover relief.
Rollover relief. This is relief for replacement of business assets.
In a nutshell, yeah.
Yeah. When they're of the right sort of assets, whether they're ships, hovercraft, aircraft, goodwill,
milk quotas,
potato quotas, all the rest of it.
Satellites are in there, aren't they?
I believe satellites probably are in there.
Yeah,
actually.
I think so.
I've yet to find my first claim for rollover relief in respect of satellites, but anyway, so you compare the share of the proceeds of the old, as with all rollover relief, the comparison is between what you get for the old asset, net of sale costs, and what you pay for the new asset, inclusive of sale costs. And the effect, we said earlier that you don't look at these things at a partnership level, you look at these things at an individual level, and therefore it is wrong in principle to say of the partnership, right, the partnership's received X £100,000 on the disposal of an asset, and the partnership has applied something more than X £100,000 on the acquisition of the replacement asset, and therefore rollover relief applies.
Okay.
Wrong in principle. Right principle is to say partnership has received X £100,000 for the old asset.
Right.
That is allocated between each of the partners in whatever their profit sharing ratios are. Partnership has applied more than X £100,000, or possibly less than X £100,000, in the application of the new asset, in acquiring the new asset, and that new cost is allocated between the partners in whatever the profit sharing ratios are, which might be different from the ratios of the old asset.
Yes.
Because the profit sharing ratios on the old one might be different from the profit sharing ratios on the new one. Indeed, the new one might be bought entirely by somebody outside of the partnership. It might not be a partnership asset at all. It might just be an asset that's used for the partnership business, but happens to be owned by somebody who's a partner. So at that level, you do the comparison between the share of proceeds and the share of cost. So as we say, you compare the share of proceeds of the old asset with the share of costs of the new asset, which has the effect that some partners may qualify for relief while others don't.
Yeah, and all the normal rollover relief rules apply as far as peer-to reinvestment, and there's various concessions that might help you out if it's not brought immediately into use or you need a bit longer, etc., etc.
All of those things can be claimed by partners in respect of personally owned assets. In principle, you can roll gains on partnership assets into the acquisition of personally owned assets and vice versa, in principle. And as I say, it's applied on a partner-by-partner basis, even for husband and wife partnerships. And in this case of Todd and Mudd, I forget what the exact allocation was, but the problem was that either the husband had the bulk of the proceeds of the old asset, but not enough of the cost of the new one, or vice versa. And the husband and wife between them, if they'd been regarded as a single person, would have qualified for relief. But sadly, they didn't, because the ownership proportions were wrong.
Isn't that where the phrase "clear as mud" comes from?
Probably not, but it should do.
Yes, indeed.
So that's how rollover relief works. It's just an example of underlining that you look at partners, not partnerships.
Yeah, I mean, common theme, as it were.
And you've got the same these old these rules that receipt of rent on the old asset or the new asset is no bar to relief, unlike associated disposal relief. Initial business use is necessary, but there's no provision for withdrawing relief on cessation of business use unless it's a depreciating asset, in which case the relief is withdrawn if it stops.
Yeah, the gain crystallises, doesn't it?
Yeah.
And by depreciating assets, an asset with a useful economic life of less than 60 years, isn't it?
It is,
it's an asset that will become a wasting asset
within 10 years.
Just say 60 years, but
yes.
We know what you mean.
Yes. Rollover relief, as we said, what seems to be a long time ago, may be relevant on mergers. So when you had A, B, and C and D and E merging, then they're all disposing of something and acquiring something. So depending on the proportions of each, they might get relief on the merger. And these are important points. But rollover relief defers gains, of course.
Yeah.
Those deferred gains crystallise on a deemed disposal of assets.
Yeah.
Or an actual or a deemed disposal of assets. They may crystallise on a change of profit sharing ratios, because that is a deemed disposal of assets.
Subject to everything we've said before.
Subject to everything. Yeah. So if you've well, here's the thing, you see.
Oh.
Here's the thing. Because if you've had rollover relief,
yes, then
it won't affect the carrying value of the asset in the balance sheet, will it?
Correct.
But it will affect the capital gains tax base cost.
Correct.
So if there is an asset on which rollover relief has been claimed, and there is then a change in the profit sharing ratios, you won't have a gain recognised in the accounts.
Yeah.
And nobody would think to ask themselves, is there a gain on this change of profit sharing ratio? Well, of course there isn't, because I've just told you that there's no gain unless there's some difference between the base cost and the carrying value in the accounts. And you've probably long since forgotten that there was a rollover relief claim when the profit sharing ratio changes, but there's nonetheless a gain that comes into charge potentially at that point. So that's a bit
okay.
Similarly, on a cessation of transparency by an LLP, if the liquidator is appointed, the assets are deemed to be disposed of at market value at that time, and at that point a rollover relief deferred gain will come into charge. And then there's the other thing that's not particularly specific to partnerships, but once a gain on assets where the gain is rolled into depreciating assets is only deferred for a limited period of time, which is 10 years, isn't it?
Correct.
Yeah.
Okay. A few points to be careful of there. On the home straight now, I think two final points we're going to look at today. The first one is holdover relief. I think we need to be careful what we mean by holdover relief, because in my simple world, holdover relief is where you reinvest into a depreciating asset. That's often called that gain is held over.
Yes.
Let's be clear here, we're talking about section 165 relief, or gift relief, I think.
Gift relief, which is
the more common phrase used for it.
Which is why it's always a good idea to tag things with the section number, then we know precisely what we're talking about. So we're talking about relief under section 165.
Gift of business assets.
Again, there's this thread that is running through this webinar, that everything is applied on a partner by partner basis. Partnerships don't make holdover relief claims. Partnerships don't make holdover relief claims. Partners do. So again, it's applied on a partner by partner basis. You compare the share of the consideration with the share of the allowable cost. You can claim it in respect of personally owned assets. Again, receipt of rent is no bar to relief, and again, it may be relevant on mergers. So again, there are no particularly special rules, except you need to remember that it's partners, not partnerships, that claim relief.
Okay, and finally, let's talk about incorporation relief, section 162 of the Capital Gains Tax Act. So this is where you transfer a business into a limited company in exchange for shares. Yes, there's a disposal of capital gains tax purposes, but incorporation again allows you to roll over that gain.
Yeah. A person with not a company includes partners in a partnership. Because again, a partnership can't claim what Section 162 relief, but partners in a partnership whose business carried on in business in common with others is transferred to a company can potentially transfer Section 162 relief. I just remind you there that business is wider than trade and may include income from property. If you can persuade the tribunal, if you get the right tribunal, it's income from property can be business. And again, it's applied on a partner-by-partner basis. So it might be that a partnership business is transferred to a limited company. Some of the partners might be paid in shares, in which case they potentially get Section 162 relief. Some of the partners might not be paid in shares, they might be paid in cash, in which case they clearly can't get Section 162 relief, but it doesn't stop the other partners from getting 162 relief. There might be some corporate partners. They clearly can't get Section 162 relief.
Correct.
But the existence of a corporate partner doesn't stop the non-corporate partners getting Section 162 relief. However,
well, as long as the whole of the business is transferred.
The whole of the business is transferred, yes.
Yeah, that's the important point. Now, I think the revenue issue's changed here a little, hasn't it? We previously looked at scenarios where you might have one corporate partner in a partnership. And what happens if you were to transfer the partnership business into that corporate member, which then issues shares to all the other individual members? Now, in the past, I think the revenue issue has been to allow incorporation relief for the individual partners on the basis that, and ask the man, is it the Clapham Omnibus we use these days? If you ask him, has the whole of the business been transferred? I think it's not unreasonable to think the answer to that is yes. The revenue.
I always thought the man on the Clapham Omnibus would have been wrong to say that, to be honest.
Okay.
And I was always surprised that the revenue took the view that relief was available.
Well, they don't anymore. If you have a look at their manuals,
you clearly transferred only part of the business because part of it was owned by the corporate partner in the first place.
I can see the argument. Anyway,
but the revenue, you're right, used to rather generously, in my view, allow you Section 162 relief in those circumstances. They now, I think, have read the legislation and realised that it doesn't actually afford relief in those circumstances. And so, as you say, a transfer of the business from where you have a corporate partnership, a transfer of the business from the individual partners to the corporate partnership partner is not a transfer of the whole of the business, and therefore you can't get Section 162 relief.
That said,
you have a solution.
Well, there's nothing, it would seem, to preclude you, instead of transferring into the corporate partner could, for example, form a 100% subsidiary. So its interest in the partnership gets transferred down to its 100% subsidiary. That's fine. The whole of the business is being transferred without doubt now.
Yep.
And the individual partners should still be entitled to incorporation relief, albeit they're getting shares in the subsidiary at that point. Yep. But we can probably do a little bit of magic dust, sprinkle that on there, and via a share-for-share exchange, etc., transfer the shareholdings up to the original corporate member.
Yeah, it would be interesting to know whether you would actually get Section 135 relief on that exchange of shares in the subsidiary for shares in the parent, given that you'd only gone through these shenanigans to get the Section 162 relief in the first place.
Well,
but it's an interesting set of circumstances.
Yeah. Okay. Well. Yeah. And that may be a topic for another webinar.
I think the point is that it is now clear that transferring to the corporate partner will not cut the mustard.
Certainly, it's clear in the revenue's eyes, isn't it? Yeah. I'm not sure it's ever been tested in court, but certainly would come with a very strong health warning. Yeah. So, phew, that takes us to the end of part 2. Bang on time, 2 o'clock. Well done, David. I think there's only really one key message today, isn't there? Which is
buy the book.
Well, sorry, 2 key messages. Buy the book. Which book's that, David? Just remind me.
That would be Partnership Taxation 2018-19, published by Bloomsbury Professional. and written by David Wiscombe, and 20% discount.
Yeah.
PT20.
Signed copies are available.
Steady on.
And the discount code is?
Somebody PT20. Somebody did ask how thick it was and how useful it would be for propping up an uneven desk, and I would say about 7/8 of an inch.
Yeah, I'd say about that. So thank you very much, David. As I say, if you want to listen again, if you've enjoyed it so much, it will be available on our website. All of our webinars are available on YouTube if you ever so fancy. Always welcome to let us have your suggestions for future topics. But for now, thank you very much for joining us. I hope you found that useful, and we look forward to seeing you again soon. So bye-bye for now.
And goodbye.